Hello. Today we're going to be doing a basic walkthrough of what a DCF looks like for this fake company, Widget Corp. Starting things off, I've kind of laid out the key assumptions that we're going to need. So we have our financials, where we've had last 12 months revenue of $100. We're assuming a 10% growth rate for that. For everything else, we're going to assume that it stays the same as a percentage of revenue. So we have our gross profit margin, our SG&A, our R&D, and then our D&A, capital expenditures, and percent changes and net working capital. We're going to assume a tax rate of 25%. For the key balance sheet data, we're going to have $50 of cash with $100 of debt. So that'll be net debt of 50. For our terminal value assumptions, or for our stage 2 cash flow assumptions, we have a long-term growth rate of 2% and exit multiple of 10 times. And then we'll also have some share count information so that we can get to a price per share. And then lastly, we have our WACC, which is going to be your discount rate. So broadly speaking, our DCF is going to fall into a couple of steps. First, we're going to have the calculation of unlevered free cash flow. Next, we'll have the present value of our unlevered free cash flow. Third, we're going to find our terminal value. Fourth, we're going to take the present value of our terminal value. Then, once we have the present value of both, we'll calculate our enterprise value, take out net debt to get to an equity value, which we will divide by our diluted share count. And the result is going to be a price per share. So, we'll obviously get more granular in terms of what each step looks like. I would say that for our calculation of unlevered free cash flow, it's going to be pretty simple. A lot of the skills related to calculating unlevered free cash flow are directly transferable from kind of any income statement modeling that you've done in the past. And I know that we've covered that in some previous videos, but kind of without further ado, we're going to just hop right in and we'll get into it. So first things first, on our blank sheet here, I'll say DCF for, I think I called it Widget Corp. Bold that, throw in a border underneath it, put it to 15 times. And so the first thing that we're going to do is we're going to calculation of unlevered free cash flow. So the way to think about your stage 1 cash flows, or your unlevered free cash flow, is how far into the future can you project your cash flows until a point of stability, where you can then calculate the terminal value, which is going to be the value of the company in perpetuity beyond this kind of initial projection period. So for us, for our unlevered free cash flow, we'll have year, we'll do year 0, year 1 through 5. So we have our years laid out here, and now we're going to start putting in some of the key information. So we'll have our revenue. So we're going to put this right here, so it's tighter on it. So we'll start with our revenue. We know that in year 0, our revenue is going to be that last 12 months. And it's important to note that we only are concerned with cash flows that are going to be generated in the future. And so in this case, we'll only calculate out our revenue for like moving forward. We don't need to look at our gross profit, our EBITDA, and all the other metrics in year 0 because we only care about future cash flows. And this kind of ties back into the fundamental corporate finance principle that the value of anything today is equal to the present value of all future cash flows. So what we're doing here is we'll have our stage 1 cash flows, which is going to be this projection period, and then our stage 2 cash flows, which is going to be anything beyond that, and we'll discount that back to today in order to get a accurate share price. So we'll have our revenue, then we'll have our growth rate, italicize that, then we'll have our gross profit, we'll have our gross profit margin, then we'll take out our good SG&A, I'll do percent SG&A, then we'll take out our R&D, percent R&D, which we're going to start EBITDA. Look at the margin here. Then we'll take out our D&A. And so the key here is after you take out your D&A and you get to your EBIT, as opposed to going to the subtracting any interest expense, we're going to tax affect our EBIT directly. So the reason that we do this is in calculating our unlevered free cash flow, we're trying to determine the cash flow that's attributable to all holders of the business. So if you think about it, net income after you've taken into consideration debt, if you took debt out up above, right? Or interest expense, I guess would be more accurate. This net income line item is only attributable to equity holders, meaning the debt holders, which make up a portion of the capital structure, would not have it attributable to them. And so by getting to our NOPAT or EBAT, which I'll get to in a second, what we're looking at is what is the cash flow that's attributable to all holders of the business. And so when we use our WACC, which is our weighted average cost of capital, to discount these cash flows back, what we're going to get is the enterprise value, which includes the value of the whole company on both the debt and equity side. And so that's what we're calculating out to. And so here, instead of taking out our interest expense, what we're going to do is we're going to take out our taxes. And so after we take out our taxes, this is going to get us to NOPAT or EBIT. You'll see it kind of used both ways, but NOPAT is net operating profit after taxes. And so the way to think about this is just your tax affected operating income. When you account for taxes but not capital structure things like interest or debt, how much cash flow do you have? So we'll have that. And to this number, we're going to add back our DNA. We're going to subtract out our capital expenditures. Then we're going to take out our changes in net working capital, because we're trying to calculate free cash flow. And this will be percent. Just like that. And this will get us to our unlevered free cash flow here, which will be our bottom line item for our stage 1 free cash flows. Okay, now that we have kind of the pieces in place, we can start moving forward with the actual projection. So first, I'm going to link over to I'm going to link over to all of our assumptions. So we'll have our SG&A, just give this 10%. We'll have our R&D, which is going to be 5%. EBIT margin we don't need, so we'll calculate it for our percent DNA. We'll have it over here. Our tax rate is going to be that 25%. Our CapEx percentage, I believe, was 15% as well. And then our changes in net working capital are going to be that 5%. And we'll assume that all of these are going to stay the same throughout the duration of the period. So I'll start pasting these over. So that way it stays the same. Okay, then I can format these. And once we have all of our assumptions kind of put in, except for our growth rate, I forgot to include the growth rate, we'll link it over. And this will assume will stay the same throughout the period as well. One other thing is typically when you're referencing other sheets, you want to highlight or change the font color to green to show that it's coming from another workbook. So I'll just make all these green so we know that these aren't hard-coded, but that these are coming from another workbook. And now we can actually start with projection. Okay, so starting with our revenue, the way we grow this is we take our previous period revenue times 1 plus our growth rate. We'll have that here. So there's our revenue. Our gross profit is just going to be equal to our gross profit margin times our revenue. So in year 1, 55, growing all the way to 85. For our SG&A, because it's a percentage of revenue, we're going to take this 10% and multiply it by our revenue. And we're assuming that it will stay consistent as a percentage of revenue throughout the duration of the period. And that's a typical assumption that you can see in a lot of income statement projections, is that it'll say something like that. I'm also going to format this because this looks ugly. Throw this over. There we go. Okay. Now for our R&D, exact same thing. It's going to be our growth rate, or our percent R&D, times our revenue. And you'll see here that I'm putting a negative sign before. And that's because I like to have all of my expenses show up as negatives. So instead of doing just normal, like this times this, and then subtracting it out in the equation, I like to have it as negatives and then to add everything. And so to get our EBITDA, it's just going to be our gross profit less our SG&A less our R&D. There we go. And to calculate our margin, when you think of margin, it's just whatever the thing is divided by our revenue. That's typically what we're talking about. So gross profit margin is going to be, as a percentage, how much of your revenue converts into gross profit. And for EBITDA, it'd be how much of your EBITDA as a percentage, or how much of your revenue converts into EBITDA. So here we have our EBITDA divided by this 110. Project that forward. Make it a percentage. We can see because everything's staying the same, our EBITDA margin is going to stay the same as well, because we're having 50% gross margin less 10% expenses. So this is all going to be situated as that. For our DNA, we're going to take this negative DNA, same as we did with the SG&A and R&D. We're going to multiply it by our revenue. And then our EBITDA, or EBIT, excuse me, is going to be our EBITDA less our DNA. And then our margin is just going to be this EBIT number divided by our revenue. And so we can see that we have a 20% EBIT margin. And now here's where it gets interesting. So we have to tax affect this. And so what we're going to do is we're going to take our tax rate, multiply it by our EBIT to get our taxes for the period. And when I add our taxes to our EBIT, this is going to get us to our NOPAT or EBIT. And so this is a really kind of important concept to understand, is that when you're trying to calculate enterprise value, which is the whole value of the company, both on the debt and equity side, you go to NOPAT or EBIT. You don't take into consideration interest expense. And so if you were trying to calculate directly to an equity value, you would take into consideration the interest expense and you'd go down to your net income and then you calculate your levered free cash flow. The difference is, instead of using our WACC, which is our kind of blended cost of capital, or weighted average cost of capital, you would just use the cost of equity. So the reason, or kind of way to think about this is, if you're calculating levered free cash flow, leverage free cash flow, you've already taken into consideration the debt through interest. So if you've already taken into consideration the debt, all of the residual is just to equity. So all that's left over is to equity, and so you'd use the cost of equity as the discount rate. And your output, your end result, is going to be equal to your equity value, not your enterprise value. So not the value of the whole company, but just the value attributable to equity holders. Okay, continuing on now, we're going to add back our depreciation and amortization as non-cash expense. And then we also have to take into consideration our capital expenditures. And so here we're going to take, just as we've done with SG&A, with DNA, with R&D, we'll take our percent CapEx, we'll multiply it by our revenue to get that, and then the same thing for our changes in net working capital, which is going to be an outflow in this case. Okay, once we have that all situated, we can add, I'll just do the sum of these three plus this. And there we go. We have our unlevered free cash flow for our stage one. So the second thing that I would do here is we're going to then discount back our free cash flow. But before we do that, we have to calculate our WACC. So we'll do our WACC calculation. So when you think about it, there's two components to our WACC, which is also our discount rate. The way to think about it is you have the cost of debt and the cost of equity, and then you have to make them representative of how much of the capital structure they make up. So first we'll do our debt. And so we're going to have our cost of debt, we're going to have our weight of debt, and then we're going to have our tax rate. And so the reason you have the tax rate here is debt is interest bearing, and because debt is interest bearing, that interest reduces your taxable income. And so by reducing your taxes, it's important that we take into consideration the benefit you receive from that. And so you have to take into consideration this tax rate, and I'll show you how we calculate it into our cost of debt. Okay, linking back here, we have our cost of debt and our weight of debt, and make these percents, and then we'll also make them green because they're coming from another sheet, and then we can calculate our cost of debt, or weighted. Okay, so to calculate our cost of debt, what we're going to do is we're going to take our costs, we're going to multiply it by 1 minus our tax rate, and then we're going to multiply it by the weight. And so this will give us 3%. Let me just make sure that this is actually coming in correctly. It should be good. Perfect, 3%. And so all you do to calculate your weighted cost of debt is you take your cost of debt times 1 minus the tax rate to recognize that tax benefit, and then we multiply it by its weight of the overall capital structure. And so there we go. We have our weighted cost of debt. Next, we're going to do the equity portion. And so for our equity portion, we can link back. We have our beta, our equity risk premium, and then also our cost of debt. So we'll link back to all of these. Format them up really quick. And so just really quick. Okay, so to get our weighted cost of equity, what we're going to do here is we're going to take our beta times our equity risk premium times the weight of equity. And so the way to think about the equity risk premium is it's the excess return that investors expect for investing in equities opposed to treasuries or beyond like risk-free instruments. And so typically this will sit between 4 and 6%. In this case, I just assumed that we use equity risk premium of 5%, but it'll typically sit somewhere in the 4 to 6% range. For our beta, we have to remember that this is a representation of the volatility of our security and its correlation to the overall market. So a beta of 1.5 assumes that if the stock market went up 1%, our security would go up 1.5%. And then similarly on the flip side, if if the overall market went down 1%, we would expect that our security would go down 1.5%. Okay, so now that we have our weighted cost of equity, our weighted cost of debt, we can calculate our WACC. Just throwing some base formatting here, but all we're going to do once we have the appropriate weighted cost of equity and debt is we're going to add them to each other. Just like that. And so our WACC is going to be 7.5%. Now that we have that discount rate, we're going to have the ability to calculate the present value of our unlevered free cash flow. And so there's a couple of ways that you can kind of go about this. I typically like to do it directly under. So we'll have our unlevered free cash flow and then the present value of unlevered free cash flow. And so this is like the kind of most basic, fundamental corporate finance theory of what is the value of something, calculating the present value of it, and it's pretty basic. So what we're going to do here is we're going to take our unlevered free cash flow and we're going to divide it by 1 plus our discount rate, and then we're going to set it to the power of the year. So year 1, 2, and 3. So I'll just project this out. And what we can see is that the cash flows further into the future are getting continually discounted further back. And so that's why even though this is $16 5 years from now, that's only worth $11 today at a 7.5% discount rate. The last thing that I'll look at is our stage 1 cash flows, which is just the sum of all of these. Stage 1 cash flows, which is sum of, actually I'll just leave it like that. So now that we have our stage 1 cash flows calculated, and remember that's just the present value of all of our unlevered free cash flow during the discount period. There we go. The next thing we can do is we can calculate our terminal value. So there's two widely accepted approaches. There is the growth in perpetuity, and then there's the exit EBITDA. So the way the growth in perpetuity works, let me backtrack really quick. Just to remind everybody, our terminal value calculation is calculating the value of our company in perpetuity, in eternity, beyond this projection period. So what is the value of the company for everything after these 5 years that we've calculated out? And so there's two ways to do it. The first is the growth in perpetuity. And so the way that this works is we're going to look at first we'll look at our year 5 unlevered free cash flow. We'll have our growth rate. We'll have our year 5 times 1 plus our growth rate. And then we'll have the present value of our terminal value. And we'll have present value of terminal value. Okay, here we go. So the way this works is we'll use the dividend discount model and treat our next year's free cash flow that we're going to grow by our growth rate as a dividend and assume that it will grow at a constant rate in entirety in perpetuity moving forward. And so we'll start by taking our year 5 growth rate, because the way the model works is we need to, our year 5 unlevered free cash flow, is that we need to grow our last projected period, this year 5 unlevered free cash flow, by 1 forward, so that way we can treat it as a dividend. And we'll assume that those dividends will continue to grow in perpetuity. So just to be clear, the way this equation works is it's dividends, or your dividend, divided by your discount rate, or your WACC in this case, minus your growth rate. And so when we do this, this will give us our terminal value. Okay, now that we all have that sorted, we're going to go back. We're going to link to our growth rate. Where is it? Here we go. Our long-term growth rate, which is 2%. And so we'll grow this by taking it, same we've done with our revenue, this times 1 plus our growth rate. Then to get our terminal value, we'll do exactly as I talked about over on the left side. It'll be this dividend, what we're treating as a dividend, divided by our WACC minus our growth rate. And so once we have that, that'll give us our terminal value in year 5. And so if that's in year 5, to get our present value, we'll just do the exact same as we did with the other ones. I can actually just cut it, or we'll do it like this. We'll do this divided by 1 plus the WACC to the power of 5. And there we go. So we just discounted back. We calculated our terminal value in year 5 using the growth and perpetuity approach. And then we discounted it back today to get our present value of our terminal value. For the exit EBITDA approach, it's a little bit different. It's similar to if you've seen any of the LBO videos I've done, where you calculate the enterprise value of the terminal value using an exit multiple. So things will trade off multiples of EBITDA. And so in this case, we'll have our exit multiple, which we'll link back to. Okay, so we have our exit multiple here, which is 10% or 10 times, meaning we'll take our year 5 EBITDA and multiply it by 10 to get our terminal value. I'm going to slide all this down one just so it links up. Okay. Oh, formatting there. There we go. And then I'll link to our year 5 EBITDA, which in this case is going to be that 56.4. And our terminal value is just going to be our exit multiple times our year 5 EBITDA. I think this number is a little bit out there. These are kind of just made up assumptions. Let me adjust this down a little bit so it makes more sense. Okay, there we go. So our terminal value at a 5 times exit multiple is going to be 281. And then for our terminal value, it's going to be the exact same equation. So it'll be this divided by 1 plus our WACC to the power of 5, because we're assuming this comes in year 5. And that'll be our terminal value. Okay. Now that we have our terminal value and the present values of both, we're going to be able to calculate our enterprise value. I'll call this, what should I call this? I'll call this calculation of price per share. There's going to be one intermediate step that we have to do before we're able to kind of finish this out, which is calculating diluted shares outstanding, but we'll start with this. So we'll calculate it both on a growth and perpetuity basis and also on an exit EBITDA basis. So starting with our growth and perpetuity, we're going to take our stage 1 cash flow and then our terminal value, or I guess I'll call it present value of terminal value. I'm just going to call this stage 2, calculate stage 2 cash flows. This is typically, you'll see terminal values called your stage 2 cash flows. And your stage 1 cash flows are kind of the earlier ones. So we'll start here with our stage 1 cash flows, which is going to be equal to our, where is it linked up here? Our stage 1 cash flows, like that. Our stage 2 cash flows are going to be equal to this 208. And then the result of this is going to be our enterprise value. So you can think about this as the value of the company in its entirety on both a debt and equity side. So it's both of them. It's the debt and equity. And it's the value of the whole company. So this is the value of the whole company. So we could theoretically stop here, but what we really typically care about is what is our equity value, and then what's our equity value per share or price per share if you were looking at like a stock or something like that. So we'll link this over because we're going to want to look at it on both an exit EBITDA basis and then also on a growth and perpetuity basis. Okay, now that we have our enterprise value, next thing we're going to do is we're going to take away our net debt. And just to illustrate what this looks like, I'm going to like type out each component. So we're going to take away our net debt to get to equity value. Okay, so we can go back, and to calculate our equity value or our net debt, we're going to take our debt less our cash. So we'll do equals our debt less our cash. But here I'm flip-flopping because I'm adding it back, but we'll have net debt of 50. Oh, lock this, because we have cash of 50 with debt of 100, so our net debt is going to be 50. So we'll subtract out that 50 to get to an equity value. There we go. Now we have our equity value. And so the last thing that we need to do to get to a price per share is we need to divide by diluted shares. The problem is we don't actually have our diluted shares calculated quite yet, so we're going to have to come back to this. But the result is going to be our price per share. Okay, so because we can't quite finish this, I'll highlight this so we know to come back to it, and then we'll calculate our diluted shares, and then we can kind of end by calculating out our price per share. So diluted share calculation. So the things that we know, we're going to link back to our other one, is we have our basic share count, our current share price, and our RSUs, which I'll link to right here. Here we go. And I'll also make these all in grid. And then we also have kind of this option information. And so the way typically you'll look at options is you'll assume that you're utilizing what's called the treasury stock method. And so the way the treasury stock method works is you assume that any option that could be exercised or is in the money will be exercised, and that the company will take the proceeds from the newly exercised options and they'll try and repurchase as many shares as they can to limit dilution. And so the way that this looks is first we'll look at new shares created. So we'll have our strike price, our number of shares. The next column is going to be new shares or shares issued. And so the way you look at this is if the strike price is less than our current share price, then have it be the number of shares in the tranche. Otherwise, have it be 0. Essentially saying if the value of the option is worth less than the value of a share, new shares should be created. So we can see that when our strike price is 3 and 4, we have conversion because we have $5 share price. But when it's 6, we have no conversion at all. The next thing that we need to look at is proceeds, which is essentially just how much money do we receive from getting these newly issued options. Like how much is being paid into us for people exercising these options. And so what you look at is how many new shares were there, and you multiply it by the strike price. So we have that here. Here we go. So we can see that our total proceeds are going to be equal to 11. Here we go. Now, with this total proceeds in mind, the last thing we need to look at is divided by our share price. And so we can get our shares repurchased. So we'll link back up to it. So our share price is 5, meaning if we take this divided by this, we can repurchase 2.5 shares. But we also need to look at how many shares were issued. It was 3 total. And so our net dilution is going to be equal to our new shares issued less whatever we're able to repurchase, and so we'll have 0.8 shares created. Okay, then to calculate our diluted shares, we're going to have our basic share count, we're going to have our net dilution, or new shares. We're also going to add in our restricted stock. Typically, you'll assume that this will convert, and so this will get us to our diluted share count. There we go. So our basic share count is this 10. We have net dilution of 0.8, and then we also have RSUs of 2. And so this is kind of silly because you obviously can't have 0.8 of a share, but for academic purposes, we'll just leave it as is. Okay, now that we have our diluted share count, we can add, or we can link to it over here, just like that. And to get our price per share, we'll take our equity value and divide it by our diluted shares. So in this case, for our growth and perpetuity approach, we'll have 16.5. And for our price per share under the exit EBITDA approach, we'll have 15.6. And so then you can kind of blend these to get a sense of what you think would be appropriate, or there's kind of a few different ways that you can look at calculating, but this is kind of the basic way. This is the basic DCF, right? You're going to calculate out your unlevered free cash flow. You're doing it on an unlevered basis. That means you're calculating enterprise value. Once you have your stage 1 cash flows, your unlevered free cash flow, you're going to do our stage 1 cash flow. Then we're going to have our terminal value, which is calculated either using the growth and perpetuity approach or the exit EBITDA approach. Lastly, we're going to do a calculation of price per shares using our diluted share count, and that's how you kind of value something using a DCF. And it all kind of comes back to this intuition that the value of anything is equal to the present value of all future cash flows. And so this is kind of an intrinsic approach, is what you'll hear people talk about in terms of calculating. But yeah, broadly speaking, this is kind of it. Let me know if that was helpful or if you guys have any other questions related to anything. Yep.